Do you want to be an investor? Have you tried investing in stocks? Do you want to learn how to start investing in stocks? I'll be talking about how you can start investing in stocks. The three basic things you'll need to get started are brokerage account, a goal and capital, and your will. Being an investor is not exactly easy. It isn't as simple as buying a stock and earning or losing. Well, that may be the gist of it, but there's so much more to it. Before we dive in further, eggheads, hit that like button, subscribe, and click on the notification bell to get updates on our latest videos. First off, we have to know what a stock is. You can't invest in something when you don't even know what it entails. A stock is basically a part of ownership in a company. It can also be called a share because when you buy a stock, you have a share in the company. When you own something, you have a right over that thing. The same goes with stocks. Having a stock in the company gives you rights. The rights that come with owning a share of the company varies on the type of stock you purchased. When you buy a stock, you're basically owning a part of that company. This means that you depend on the company's success and earnings. Usually, people refer to the S&P 500 when talking about the stock market. What's the S&P 500? It's where you can find about 500 companies that are popularly traded in the US stock market. It's an index where you can see the stocks of these companies. You can also see headlines about the stock market and these companies. The company's profitability is what makes the value of the company grow, which in turn adds more value to the stocks that are owned by shareholders. How are you able to know if the company you invested in is doing okay in the market? These companies file their financial paperwork on a quarterly basis to the Securities and Exchange Commission, or the SEC. The public is updated on the progress or standing of these companies that are publicly listed. From 9:30 a.m. to 4 p.m., the stock market is open from Mondays to Fridays, so you can constantly check on the stocks during the open hours of the market and watch the stocks move. These stocks can move in a matter of minutes or hours or on a daily basis. You wonder why that may be the case. The reason is because there are all kinds of investors in the market. They all have their own approach and strategies when it comes to investing. And when doing so, they assess the data of these companies. People are buying and selling stocks every minute. Other stock exchanges you'll find in the US is the New York Stock Exchange, or the NYSE, and NASDAQ, which stands for the National Association of Securities Dealers Automated Quotations. These platforms can be used globally and are open from 9:30 a.m. to 4 p.m. Eastern Standard Time. For a long period of time, there was a fee set in place when buying stocks. You would order a stock and the broker would get a commission to start the process of you purchasing a stock. The fee may not be a substantial amount, but the accumulation definitely makes a huge difference, especially for those who are just starting to get into the stock market. Now, fortunately, you have many commission-free brokers to choose from where you can get into stocks and sell stocks without a fee. You would still need to choose wisely what brokerage to use because they all have their differences, which means they all have their pros and cons. Those without commission usually will give you less offers and less data on the companies since they don't charge you a fee. Say you have already chosen what brokerage to use. The next step you'll be taking is the transferring of money. There are important things you need to know. Having capital, which is money you're going to be investing that you won't need. It's supposed to be money you're willing to put in, expecting that it's going to be a long process until you get a return. The market is volatile. The returns could be at extremes, between -4%, reaching as high as 22%. You shouldn't expect to get a substantial amount of profit from your investments at a snap of a finger. If you invest money, which you will need, then you'll be forced to make decisions on buying and selling stocks, not for the long-term benefit. If you're new to investing, index funds are probably your best choice. You can actually have a diversified portfolio at an instant, even as beginners. How exactly can you do this? You can buy a share in a fund which tracks the index. This will allow you to own a share in each company all at once. For some, they like to buy individual stocks. With over thousands of companies to choose from, It's easier if you categorize them first. You have your large and small companies. One of the usually used methods to categorize and narrow down your list of choices is through market capitalization, which you can also learn more about in an Egghead video. Market capitalization is basically the value of the company. In market capitalization, you categorize these companies by their market cap. There are three market caps: large cap, mid cap, and small cap or micro cap. All these companies vary, so they all have their own pros and cons. Large companies being more stable since they're usually the more mature companies. These large companies are more stable but have less room for growth, so possibly less returns. For mid-cap and small-cap companies, these companies have lots of room to grow, and if the company is successful enough, then these could have larger returns compared to large caps. However, still riskier than investing in a large-cap company, since these mid and small-cap companies have yet to establish themselves to remain successful in the long run, but could progress to becoming large-cap companies, meaning there would be a higher value of their stocks, which can benefit you as an investor in that company. As a newbie in stocks, it's preferable that you not choose small cap companies, since there's more risk and less stability. Another way you can categorize is by focusing on the dividend stocks and comparing them to growth stocks. New investors usually choose dividend stocks over growth stocks. Dividend stocks are large cap companies that pay dividends to their shareholders at a fixed amount on a regular basis. Growth stocks are usually mid cap or small cap companies, but have a lot of growth and are more progressive since they haven't reached their peak. It's good if you look for a company to invest in whose products or services you already consume. This way, you already know the nature of the business and the quality they produce as a consumer of their goods or services. That's all for this video, Eggheads. Don't forget to leave a comment below, hit that like button, subscribe, and click that notification bell to be part of our Egghead Finance community. See you in the next video.